Welcome, everybody. Thank you all for joining us for another Wednesday night. How exciting. Just a few more and the semester ends, right? Y'all excited? No? Up, down? Yeah? Hype? Awesome. Good to hear. So I think I'm sharing my screen with Zoom here. Y'all can see it up there. Let's go ahead and get started with the society meeting. So this is our general agenda for today. We're going to start off with outperforming moments, of course, market outlook, economic outlook, M&A, the sweet spot, and then we have a lot of society updates. So please stay towards the end, not only for the gift card, but to hear valuable information for the society. All right, so first thing, outperforming moments for the week. What do we have, y'all? What's been going on? Any job offers, scholarships? Yes. That's good. That's a good outperforming moment. Proud of you, Juan. Okay. Let's get two more outperforming moments. Anybody? I do, Carlos. I actually won. What? Yeah. So this week I got a scholarship from the CFA to take the CFA for like a way cheaper fee. So I'm hyped. I'm probably gonna take the CFA in 2024 though. It's still applicable. Yeah. Okay. One more. Come on, MDs. Yes, Alina. Nice. Congratulations. Huge things our members do. Awesome. All right, so today I don't have a quote for the week, but I have an opportunity here. So it's a summer venture in management program directly through Harvard. So if you scan the QR code, it's going to take you to the information, the website that they have there. Application deadline is April 12th. I believe that's for juniors or seniors here interested in getting an MBA. And I think it's a great opportunity to look into if you're interested in. I think I will be applying as well. So give you guys a second to scan the QR code. But I'll share your slides, of course, in the socials. All right, let's move on. Now for the sign in. Everybody pull out their phones here. Sign in for the gift card as well as overall attendance. Participation, guys. I think it should be active. Yeah, okay, cool. All right. Looks like everybody's still signing in. Got it? Yeah. All right. It looks like we're good to go. All right. Let's start with the market outlook by Juan Carlos Sanchez. Round of applause.
Hello, everybody. I hope y'all are doing good. You know, the market seems to be doing not too bad this week. Today, week movement 2.31% up from last week that we met up to today. So good news on Monday. So basically the S&P went down throughout the end of the week last week. And then I don't know if y'all have heard, First Citizen Bank decided to acquire assets from SVB. So as you can imagine, that was pretty good news for investors, brought up the market up. And you can see that on the pretty slight scale on the S&P. And then we have there the dates. So this is today. Today, the S&P closed at 4,027 points, went up 56 points or 1.42%. And you say they were previously on the March 27th. That's today, Monday opening. That's when First Citizens. Yeah. Only 0.16, but there was a bigger increase for the bank industry. S&P 500. This is today. Pretty good. All green. Not a bad sight to see. You can see tech stocks still doing up. You see the financials on the bottom left. You see the banks as well as the regional banks in a small little square towards that black box, still on the bottom left side. Amazon, Tesla still green. well as consumer stocks. Now, updates on last week's. Banks are still pretty hot topic. Starting to cool down, but here we see First Republic Bank. So for the week, it rose 7%. Pretty good, but they're still down. They're still down at $14.26 compared to how they were before. But you can still see that increase on the 27th. You see from March 24th to the 27th of First Republic Bank. First Republic on the left side. Pretty big increase. And then slight down, but today went back, popped back up. See Credit Suisse there, still not doing too good. Their stock is still at 80 cents, even though UBS acquired them, and it's still in the works. So a little insight on UBS and Credit Suisse. In order for UBS, another Swiss bank, to acquire Credit Suisse, Swiss lawmakers had to change and move around laws so they could acquire them, so it wouldn't be considered a monopoly. And they're trying to, I read an article, they're trying to actually push that date sooner for the merger to occur. So you can see it was down 3.73% this week, closed at 80 cents. And since the beginning of March, it's been down 71%. You see here for the weeks, the pricing as well as the change, 6% for Wednesday to Thursday on First Republic, and then a big increase on Monday, which is for Citizens' announcement for acquiring assets of SVB. Same thing with Credit Suisse, just a slight 0.53%, and then 4%. Stocks for banks were pretty much at a good standing today. They rose a decent amount. So a little bit about the bank industry. Throughout not a major bank closure, thank goodness. We didn't have another SVB or Signature Bank occurring throughout this weekend. So they had a pretty good positive outlook for Monday, and even more so with the First Citizen purchase of the SVB assets. And First Citizen's share price went up 54% on Monday, or $313. So this put confidence towards investors, brought up the stock market as well as the bank industry in the S&P 500. So during Monday, S&P went up 0.16%, but bank industry went up significantly by 3.05%. And the bank industry is to be affected. Tuesday, they had a meeting with the Senate to push further regulations on capital and liquidity issues. So capital, so they could either not pay too much attention and tank of any losses, and liquidity to hand out banks, which is what SVB had a problem in. You see on the graph, First Citizens Bank just shot up on Monday, as well as closing of today, $941. Now, banking regulation. So what I was mentioning before, Tuesday, there was a Senate Banking Committee with Federal Reserve Vice Chair of Supervision, Michael Barr, and he anticipates the strengthening of capital and liquidity rules, which is essentially what SVB had problems with. And funny enough, back in 2018, this was actually loosened from a 2010 Dodd-Frank law, which had banks over $50 billion in assets to undergo stress tests to test these capital issues as well as liquidity issues for any to occur to get them fixed. But in 2018, during the Trump administration, they pushed that 50 billion assets to 250 billion assets. So significantly way higher, which put SVB under that 250 billion bracket. You see, pretty much helped them. They struck gold in, flying under the radar and going down. Now, another topic, not losing interest. So as you see last week, the Fed increased by 25 basis points, and investors also infer lower rate hikes due to what is happening with the banking industry, as well as, still trying to keep a hold of inflation. The Feds aren't planning on increasing too high or too aggressive on rate hikes. Decreasing on banks helped a lot more in controlling those inflation and interest rates. So thing to consider is the US dollar weakening against other currencies. I know today there was an article where China, as well as other Eastern countries, were starting to not really put too much faith in the dollar and going with the Chinese currency. And we could also see gold increasing in value throughout this year. You see in the top right, gold. That's what it closed today at $1,900, and that is from year-to-date difference. It was roughly 1850, and closing at 1972. And for any future rate hike, on the bottom left graph is basically investors like what's going to happen next. Is it going to go above? Is it going to go below? Is it going to stay? So when SVB collapsed, they basically just switched mindsets, and they're either going to freeze rates or they're just going to maintain it and not increase too high on rates. Next, we're going to LinkedIn. Next, we have Alex with Economic Perspective.
How's it going, guys? Alrighty. So you guys wanted Credit Suisse. We got Credit Suisse this week. All right. So, Credit Suisse was not doing too hot, and it hasn't been doing too hot for the past, decade or so, since 2008, really. And so this chart shows us just since 2020 and all the fraud and scandals that it's had since then. Right? So, and this is not even all of it. So, in 2020, Thiam, which is the former CEO, had to resign because the COO hired a private contractor to follow one of their former wealth management bosses. And the wealth management boss, he caught the private contractor, and found out it was the COO who hired him. So then, in 2021, early 2021, they incurred a $10 billion loss from Greensill. That was mainly their investors' money. So those are wealth management arms that lost $10 billion. Then they lost $5.5 billion loss from Archegos Capital. Archegos went under. And then their chairman was forced to resign for violating COVID-19 rules in late 2021, which is I didn't know COVID-19 rules were still on during that time, but okay. And then February 22, there was a leaked data, right, which showed that they served human rights abusers, corrupt politicians, and sanctioned businessmen for decades. And then, they were found guilty to failing to prevent a Bulgarian drug lord in a cocaine trafficking for money laundering. So, they weren't, obviously not serving the most nice people, but that's how they make their money, right? Switzerland. And then in 2022, they announced that they lost $8 billion, which is the most or the biggest annual loss since 2008 for them. So, and on the bottom here, Anna will share with you guys the slides. This is just a cool video that I found that goes over basically all these scandals in depth. So thought I'd share that. So how it all started, Credit Suisse announced, well, they were going to put out their full year 2022 report, financial report. Then the SEC called them up and said they needed to recheck their financial statements because there were some errors. So they rechecked it and they released it a couple of days later. And they said there was material weakness in their financial reporting procedures. And then, after a little bit after that, maybe because of this, but Saudi National Bank said they were going to stop funding. So the reason they said they were going to stop funding them was because they already had 9.9% ownership in the company, and so they went over 10%. They would have to deal with like regulatory issues, which they said they didn't want to, right? But who knows if it was because of this material weakness or it was really because of the regulatory issues. And they were down 98% from all-time highs since 2007. So they really haven't been doing too hot. And so since then, since all of 2022, they've battled with liquidity, right? So in 2022, they had higher withdrawal rates than they had inflows, and there was like higher net asset outflows, which I will show, I think, on the next slide, just how much assets have decreased in the past couple of years, people taking out their money. And so this is important really because Switzerland has a huge exposure to the banking industry. As you can see here, this is the bank assets, so the banks that are in Switzerland compared to the annual gross domestic product of the country. So the bank's total assets compared to the GDP of Switzerland is about a little bit over 500%. In the UK, it's about 380%. In the US, it's a little bit over 100%. So you can see that they're really exposed. Switzerland is really exposed to the banking industry, and so that really drives their economy, right? So that's why Switzerland really wanted to broker this deal to make sure that it goes through and they don't lose that GDP, or what is driving their GDP, right? Because if Credit Suisse went under, they would lose a lot of money from that, in a lot of investments in Switzerland. So the Swiss central bank gave them $50 billion to shore up capital, which worked for a short period of time, because I think after this, I think the stock price went up like 14%, I think, or it was 9%. And then the very next day it went down again. So it really didn't help. And then, Swiss National Bank, which, Juan Carlos said that they had to break some or change some laws to get this deal to go through, and really force UBS to buy them, which I don't think really UBS did not want to buy them. So they bought them for $3.25 billion, and then offered a $108 billion loan to help the deal go through. And so Credit Suisse really matters here because it's one of the 30 global financial institutions that are deemed systemically important, right? So that means they're a too big to fail bank, right? So when they're too big to fail, it's going to impact a lot more than just Switzerland. It's going to impact investors all over the world. So you can see here that their assets, which their assets ranged from or they were 912 billion at the end of 2020, which decreased to 574 billion. So that's all that net asset outflows. But 574 billion at the end of 2022 is still a very big amount, and so that can affect a lot of people, a lot of markets. And their asset management arm holds $1.7 trillion in assets under management. So that's also another big factor that would have been bad if Credit Suisse went under, right? So in this UBS deal and Credit Suisse deal, UBS, this is what they reported. UBS is going to have now a total or around $5 trillion in invested assets. So they're going to become pretty big, right? They're going to be the #1 bank in Switzerland, which may be a good thing, may not be a good thing, right? And also this threatens, Switzerland's credentials as the I guess wealth management hub. So you guys might have heard of contingent convertible bonds. Maybe in the group chat we were talking about that. And so what are they? What are contingent convertible bonds? They're also called AT1 bonds. Maybe you heard of that. So these bonds basically are convertible. You can convert them into equity or write them down, which what they did in this case, right? So there's like what these investors didn't realize was that on the footnotes of these bonds, of the legal proceedings, there was said that in certain circumstances they can just write down these bonds and decrease their value to $0. So they act similarly to preferred shares. So if you see this capital stack here, this is how the capital stack works. The senior debt has the lowest equity, has the lowest risk. Subordinate debt, which is like mezzanine debt, has a little bit more risk. And the preferred equity has a little bit more risk, and then common equity has the highest risk, right? And so the highest risk has the lowest priority of repayment, and then the lowest risk has the highest priority of repayment. This is what like a normal thing looks like, right? So if a company goes bankrupt and they only have enough assets to cover senior debts, then common equity, preferred equity, and subordinated debt is going to get wiped out, and they're going to be left with $0. And so in this case, what happened was that the COCO bonds, which are the contingent convertible bonds, they got wiped out to zero, and they act like preferred equity, right? So common equity shareholders got a portion of the money, but while the bond holders, the debt holders, right, they got $0. So that usually doesn't work like that, and so that kind of made the contingent convertible bond market fall, and raised a lot of questions into legality and stuff like that. But like I said, it was in the footnotes, so I guess they didn't realize that when they invested in it. So the deal was that shareholders would receive one UBS share for every 22 and 48 Credit Suisse shares held. The contingent convertible bond market was 275 billion markets, and I'm not sure. I think it decreased. I forgot what was the number it decreased to. The total wipeout of Credit Suisse's contingent convertible bonds was 17.3 billion. So that's a lot of money, obviously. And so after this statement, or after this happened, the EU said that they are not going to usurp the capital structure, and like Switzerland did. So I guess it's a relief for some investors that hold these contingent convertible bonds all right. So the Federal Reserve increased the inflation or the interest rate, 25 basis points last week. We talked about that, and so I just wanted to show this because you look at this chart. This is what is happening to most banks, right? Currently, they bought the bonds at $100, right, par value. Then, as interest rates increased, which they work reversely, so as interest rates increase, the price of these bonds go down, right? And the orange shows the total unrealized losses across banks because of this this pressure that's the interest rate pressure that's happening, right? So the reason they we can why do you think they increased interest rates, right? There's two reasons. Maybe because they thought that the banking sector was already calm, and there wasn't any risk, other issues that posed a risk to the banking industry, and that could be because of the bank term funding program that they set up, right? So the bank term funding program I talked about last week just basically covers all uninsured deposits. They hold collateral, the held to maturity securities on the bank's portfolios in return for securing the uninsured deposits, right? So there's really not anything to worry about if the bank goes under. Your uninsured deposits are going to be covered. So I guess maybe that's why, we can just raise it. There's really no other issue to raising it. But there's another thing that poses an issue to raising, right? So maybe if they don't raise it, maybe that they're like, okay, there's more to be worried about in the banking industry than the Fed is saying, and so that's going to cause more panic, and that might cause more depositors to take their money out and put them in different banks, which is cause more bank runs and more bank failures, which is just not a good thing. So I guess they decided to go with 25 basis points to really tackle inflation and show that the banking industry is sound. So in the bottom here, there was an increase in unrealized gains and realized gains. So the banking industry, as interest rates go up, of course, the unrealized gains is going to increase, which doesn't really matter until it matters. Until they sell these assets, then it matters, and it shows on their balance sheet, right, on the income statement. So there's just right now a total of 620 billion in unrealized losses across the bank. That's it for me, guys. I hope you guys enjoyed.
Hey guys, so today I'm going to talk about the acquisition, how first season take over SVB. I'm not going to go into in depth about SVB because Alex pretty much covered everything last week. So let's get an update on it. Isn't it crazy how a 16th largest bank in the US could collapse in 48 hours, which marked the second largest bank failure in the nation? Silicon Valley serves thousands of startups, especially in technology and venture capital. As of March 10, SVB has approximate of $167 billion in total asset and about $119 billion in total deposit. And SVB was taken over by FDIC 2 weeks ago. I'm sorry. And it estimates the failure would cost the deposit insurance about $20 billion. And as in the deal, FDIC include what they call equity appreciation rights, which allow them to keep some amount of the asset that SVB was failed. And it retained about 90 billion of SVB, $167 billion total in asset. And even though Bank of England has warned US long before its collapse, we still kind of failed to make it lane as soft as possible. And let's talk into First Citizen Bank. It's the largest family-controlled bank in the nation. And during the process so FDIC was trying to run an auction for the bidders. And during the process, it has run two unsuccessful auctions for SVB, and it takes weeks for the deal to get through. And each day gone by could devalue the asset of SVB. But finally, First Citizen agreed to buy 72 billion chunk of Silicon Valley Bridge Bank. This is what they changed, even though the original name was SVB. And the 17 branches of SVB gonna be open under First Citizens. And this deal includes the purchase of deposit and loans at discount of 16.5 billion, which are around 25%. This actually this is a second transaction deal that same share of the acquisition soaring, as you can see in the chart for First Citizen. And after acquiring all the asset from SVB, First Citizen Banks is now a top 20 US financial institution by asset, based on asset. And there's some additional information I want to give, because since this deal was made like 3 days ago, there's a lot of missing information. But First Citizen Bank has a history of acquiring many failing banks, which they has acquired more than 20 FDIC assisted banks since 2009. And it also acquired CIT Group last year in a deal value of $2 billion. And whether this deal gonna be good or not, we have to wait to see. That's gonna be it for today.
Am I up here? Anna? All right. So, I started my career in the 80s. Y'all remember the 80s, right? Your parents don't even remember the 80s. But we had something called the SNL crisis. It wasn't Saturday Night Live. You may know what the SNL crisis was. Savings and loan crisis in the US. And I learned a theory in finance that I thought was pretty interesting, and it applies today. And it's understanding the difference between a stock and an option when it comes to valuation. Y'all know what a stock is. You know, I kind of know what an option is, probably most of you. But they're very different animals. So a stock is, the value of a stock is the present value of future cash flows. If the risk goes up, the discount rate goes up and the stock price goes down. So there's an inverse relationship between risk and valuation with stocks. Lower risk, higher value, higher risk, lower value. With options, risk increases the value of an option. There's a direct positive correlation between risk, higher value. I thought it was interesting reading the history of Black-Scholes. I don't know if you've heard of Black-Scholes. That's the option pricing model. Probably one of the most successful theories in finance. It started making money almost immediately after the theory came out. But I was reading the history of Black-Scholes. They tried using the theory of stock valuation when they first tried to come up with a model to price options, and they said that doesn't work. And so they came up with Black-Scholes, a model where volatility is not only the key input, but also goes in the same direction. Unlike what you learned, capital asset pricing model, risk makes the discount rate go and the value go down. So we have these two securities that are valued very, very differently. One hates risk, one loves risk. So what does that mean for the banking industry? Well, did you know, I don't want to blow your mind, but this is actually pretty important. Did you know that stocks are really options that are deep in the money? What does deep in the money mean? So let's say Apple's trading for $150. Would a call option at 100 be in the money, or a call option at 200 be in the money? 100 be in the money. Why? Because it's worth 150. If I can buy it for 100, it's in the money. Well, a stock can be considered a deep in the money call option, which means you can use option pricing theory to value a stock, but it's a very unique option. It's deep in the money, which means the company's worth a lot of money. So deep in the money options are very different than at the money options. So what does that have to do with what we're doing today? Well, I've got two options here. You can barely read it. Pepsi and Tesla. Which do you think is the more volatile stock? Tesla, all right. They both have about the same stock price, but the 90-day vol, and the 90-day vol is probably the most important input to an option price. The lower the vol, the cheaper the option, the higher the vol. The 90-day vol for Pepsi was 14%, for Tesla is 74%. So I buy an ATM call option. What does ATM mean? At the money, not an automated teller machine. It's funny, I was watching a video, they're asking these 20-year-olds, what does ATM mean? And they had no idea. Do y'all know what an ATM machine is? Y'all don't even use them anymore, do you? So, but here it's at the money. An at the money call option for Pepsi was $7.70. For Tesla was $29. You can see the higher volatility made their option much, much more expensive. If I take the options time value, which the time value is essentially the entire option price, because when you're at the money, it's all time value. You can see as a percentage of the stock price that the Tesla stock is the option is just much, much more expensive. Then I did 30% in the money. And there you can see the option premiums are about the same, but the difference is at the money, your option has zero intrinsic value. All right. So, if it goes down, you're just going to lose the option premium. When you're in the money, you have a lot of intrinsic value, which means you care about the value of this firm. All right. So what does that mean? So here I'm going to blow your mind. So think about this. When you're deep in the money, you care a lot about risk. When you hate it, you hate risk. You're deep in the money because you have a lot to lose. When you're at the money, you love risk, right? Because if the risk goes on the downside, you're already at zero anyway, intrinsic value. But the risk goes on the upside, you get to capture all that. Well, what is a bank that's in serious financial difficulty? Is it deep in the money or is it at the money? The S&L crisis in the late 80s, those banks were essentially worthless. All right. So let's say you're managing a bank where now your stock value is essentially zero. Do you want to take a lot of risk or do you want to avoid risk? You want to take a lot of risk. Which world are we in? Discounted cash flow or option valuation? When your stock is essentially worthless, you're in the option world. You want to gamble as much as you can. And that was the problem in the S&L crisis. We had a bunch of banks where their management knew their company was worthless. And so what did they do? They started gambling on these real estate investments. It was like, hey, they're probably not gonna work out, but if they work out, we get to keep it all. If they don't work out, it goes to the taxpayer and it goes to the FDIC. So what is management's incentive when a bank stock value approaches zero? It goes from being a deep in the money call option to being at the money call option. The goal of management, their smartest, I'm not saying they're evil, I'm saying their smartest economic move is to roll the dice before the FDIC figures out that they're worthless. And they're gonna know that before the FDIC does, especially in SNL, because these are small kind of community banks, no one's really paying attention. It's not, Silicon Valley, 200 something billion, but we're talking SNL's a bunch of them, but really small banks. Yeah, management is like, hey, we've lost it all. We have nothing. We had our entire net worth and now it's zero. Let's do some pretty crazy loans. If they work out, we do great. If they don't work out, we're no worse off and the taxpayer gets it. Do you see why regulators need to step in really fast? Because if they don't step in fast, there's going to be an option where it's heads, management wins, lose, tails, the taxpayer takes it up. All the downside risk goes to the taxpayer. All the upside risk goes to the stockholder. The reason I love this kind of idea is it shows you that there's really two worlds of valuation: stock valuation, which is discounted cash flow, and option valuation, which is the probability you're going to be in the money. And if you use the wrong math in the wrong place, you're going to make a really bad decision. You got to know when to use option theory, option pricing theory, and when you use DCF. DCF is probably 90% of the world. But if you're in the 10% and you think you're in the 90, you're going to make some really bad decisions. And so that's why regulators need to step in, because management for some of these banks is in that let's roll the dice world. All right, that's it for me. I guess we're going to end a little early. Well, you said you needed some time. And those pictures are all pictures we took in Costa Rica, except for the bluebonnets.
All right, awesome presentation from everyone once again, very informative. Looks like we might get out a little early today. So now for the semester outlook here, what we got going on. A lot of important dates coming up. You might want to take a photo of this if you'd like, but we are going to share the slides. So a reminder again that the Sergio Silva Scholarship is due by April 6th already by 5 p.m. emailed directly to Professor Sweet. And we also have a kickball tournament, again, another fitness activity for the Investment Society to be involved with. Next Friday, April 7th, hosted by the Business Student Council. And then I think the week after that, yeah, right, because it's a Friday, on April 12th will be MD elections in our second meeting from now. Really important date. Everybody should be here to put their vote in, as well as those who are interested in running for a position. I'll talk about this in a bit. And then after that, we are gonna close the Market Watch competition, and April 13 at 4 p.m. We're gonna have our guest speaker from JPM, who's half a UTSA alum, to discuss on how to navigate your career, April 13th at 4 p.m. We're gonna send more information on this once he 100% confirms. Right now he's at 99% confirmation, so just FYI. And then I wanted to ask if anybody was I guess show of hands of how many of y'all would be interested in UTIMCO coming down to have an informational session. I see Carlos is giving thumbs down, but it's good to know how UTIMCO is managing our funds, because we're under them. They're managing all of UT's funds here in Texas, right? And then our society spring formal, we finally have a date for it. It'll be April 26th at 7:30 p.m. This is a Wednesday night, usual meeting time, so hopefully everybody will be able to attend. This is from the form we sent out last week. But yeah, if y'all, yeah. Yes. Good question. I'm not sure. Let me double check on that. I think this is supposed to be the 19th. My mistake. Yeah, okay. Our final meeting, like the general meeting, not the formal, is where we vote. Yeah. So this is a typo. This should be 19th. I'll fix that before sending you the slides. So speaking of MD positions, I think it's a great resume builder, develop all sorts of skills, soft skills, hard skills, leadership, overall creating an impact for the investment society. I think the MDs and I can speak highly. Everybody, UTSA alum can speak highly of the investment society through the amount of help and effort we've put into this organization and the amount of resources and skills we've learned. It's immense here. So the end of the academic school year is already this semester. Next semester is entirely new. All positions are available for running. President, VP, treasurer, market outlook, chief economist, M&A, marketing director, and social chair. These positions, the way we run for them, if y'all aren't familiar with it from last semester or the previous semesters, so basically you just email us stating which positions you would run for in order. Like if you want to run for president, and if you don't get president, well, I'll be an M&A type of deal. You submit 1 or 2 slides to our email. That's typo 2. It's not November 16th. I'll fix that. To our email by April 12th. And then we'll rank you, like who submitted their email first, of what MD position they're interested in. And then before voting actually happens, you'll come up here and we'll verify with you as to what position you're running for and if your slides are approved or whatnot. And then voting happens. But for the actual presentation, before everybody votes for you, whether yes or no, you can be president or VP. We want all presentations to be a maximum of 3 minutes per person for each position you're running for. Now, I highly suggest them. They're all open. I've been president for, I think, 2 years now, or a year and a half. And there's a lot of opportunities here to develop. And speaking, well, here's some examples, actually. These were mine when I ran for president, I think last semester. Right, examples. Literally 2 slides tops, straightforward, what you're running for, who you are, your goals for the society. Here's more examples of Juan Carlos. This one has a lot of dynamics, but there's that one. And kind of to highlight overall development as being a leader in an organization like the Investment Society, I wanted to highlight one of the events me and Alina actually attended for representing the society at this advisory council meeting through UTSA. These are just some photos. We went on this Tuesday, to present to the board here about what the society is doing for Costa Rica directly. And I was nervous, but I presented in front of important people, which is always a good skill to learn and improve on. But that's us with the dean right there, if y'all recognize him. So once again, highly suggest running for an MD position. And this is an RSVP for the formal. Like I mentioned, the formal is April 26th during our general meeting time. Hopefully everybody can attend because we're going to be selling graduates. We're going to celebrate the scholarship recipients, Sergio Silva Scholarship, and as well as the EMBA EMBA scholarships, the Market Watch winners, as well as free food. So if you're not interested in anything else, I'm sure you'll be interested in free food. So please take a moment to RSVP real quick. Make plans to attend. And for those graduating this semester, if your name is not on there, let me know, like reach out to us after this meeting so we can keep track of it. Because we do want to celebrate y'all, and we'll be reaching out to y'all who are graduating this semester on email so we could get some information, so we could, have a nice presentation during the formal with a photo where you're going after graduation and what you contributed to the society. And as mentioned before, with the kickball tournament with BSC, we do ask you please RSVP so we can make sure we have the 9 members that are required for this event. Come represent BSC. Has anyone played kickball? I have not. Do we have good kickball people? Okay. Awesome. That looked more than 9 or about 9, so that's perfect. As long as y'all can please come out April 7th and help us win the trophy. All right, so I'll give that a go. And this is the updated Market Watch competition. We have our top 10 players right now. And there's immense returns. First place right now is Jacob. Second places are VP Devin. And then third place is Andrew. So remember, it's never too late to start and investing in the Market Watch competition because the first place winner does get a $100 gift card. That's free money playing around with fake money. So I don't see an issue with this. And the market's volatile as we've been seeing, so make some risky trades. And as always, we are selling our society merch. If you are interested, polos and t-shirts. And now I think we're safe to roll for the raffle here. For the gift cards. Straight ready? All right, perfect. Let's get a drum roll here.
All right, guys. All right. Can we please get a drum roll, please? All right, the lucky winner is Miranda Madero. Miranda, are you here? Okay, no problem. Miranda, you missed out. All right, the second name I have here, drum roll, please. All right, it's Kenneth Nelson. All right, Kenneth, meet me after and I'll get your information. The other one I have here is. All right, I had him already. I get it. All right, the other one I have here is drumroll, please. Lucky winner, Alex Guyo. Are you here? All right, man. Meet me after, and we'll get your information. All right. I also wanted to mention, make sure to check your spam emails, because it might get lost in there. They might think of it spam, so just check your spam if you got a gift card, and it should be in there. Thank you.
Awesome, y'all. If there's no further questions, I hope y'all have a wonderful night and see y'all next week. Stay involved in our socials, please. Thank y'all for coming out.